All right, good morning. Welcome to this month's Capital Markets Update and Outlook call. If you are here with us live today, welcome. We want to thank you for being here. If you are watching this in the recording, we also want to thank you for taking a little bit of time out of your busy holiday schedule to join us here today. This is an important call. We do it once a month, and we are very much so looking forward to delivering our 2023 capital markets outlook for next year. So let me go ahead and share my screen and we will get started here. So if you are joining us today for the very first time, also welcome to you. My name is Eric Hagen. I am a financial advisor. I am president of Capital Consulting Group, or CCG. CCG consists of myself, of Chief Investment Officer Tom Fox, who you will hear from in a minute here. Financial advisors Dan Oshman and Rana Grant. If you are clients of Dan or Rana, a special welcome to you as well. And then we have our client support team, John Knutson and Marilyn Westmark. Our goal is to help our clients make their next financial decision, and the one after that, a good one. That is the secret to prosperity. We call it steady plotting. We do this by helping you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. If you'd like to learn more about this, you can go to clearfinancialfuture.com and watch the short 2-minute video. And we give our clients' life savings the attention it deserves with our Smart Mix portfolio solution. Smart Mix is our personalized portfolio solution for individual investors, whether you have $25,000 or $25 million. Smart Mix is our process for helping you get and stay invested right. If you'd like to learn more about this when we're done here today, you can head out over to smartmixportfolios.com. Additionally, every Monday, I broadcast live on our website. I do a short recap of what happened in the markets the previous week. You can also watch this on LinkedIn, Facebook, or YouTube, whatever your favorite platform is. And then I send an email once a week, Mondays, about 3 o'clock in the afternoon Central Time, with a link to that recording and then links to anything else that we have coming up that we want you to pay attention to. You can subscribe to this email at, again, our website, investwithccg.com. All right, like I said, today we're going to hear from our Chief Investment Officer, Tom Fox. Tom will review where we are in the markets, kind of talk about the positives, the headwinds, and today, a little bit different than most of these monthly calls, he's going to give us his outlook for next year, for 2023. Ultimately, this is kind of your opportunity to look over our shoulder, get an idea of what we're seeing in the markets and the economy, and kind of what we're watching for. Tom spends most all of his time more behind the scenes doing research, due diligence, running different analyses, really focusing his attention on the economy and the markets. He has over 35 years experience building investment strategies, monitoring the markets. He's got a very long, impressive resume, as you can see here on the screen. So Tom's message today is one that I look forward to all month long. So with that, let's go ahead and bring Tom in here. All right, there he is. Welcome, Tom.
Good morning. Thank you, Eric. Good morning, everybody. What an exciting time to give a 2023 forecast. We were in unusual times, to say the least. So I'm very excited about this, and we'll be try to make it as clear as possible what we see coming, and then try to put it all together at the end. And I want to start off by saying that in today's unusual economic and market outlook environment, we're seeing a wide variety of views coming from a host of very smart investment strategists from some of the biggest firms. And I've never seen in my history such variety and differences. So there's opinions all over the board. So we're going to add our opinion to the many out there. Of course, ours is probably right by the time we're all done. But we don't take this lightly. We spend a lot of time looking at what's going on, where we think things are going. So here we go. We'll start the presentation. And so the theme for 2023 is Wag the Dog. Actually, there was a movie where it was about a war that was made up, and it was about wagging the dog. But what does that idiom mean? It means that something of lesser importance actually moves something of much greater importance. Now, what we're thinking about in wagging the dog is I don't want to call the Federal Reserve Board the dog, but this time we are. We believe that something of lesser is going to move the Fed, the dog, into moving sooner than later and making a pivot. And there's 3 different pivots. We'll talk about that. But we see that coming next year. And just a note on the rest of this year, we said it would be a good first half, a bad first half, followed by a really good first half. We were right on the first half. In the second half, I think we got up to 8, 9, 10% in the second half, but now we're barely over zero. So we're about 1%, 2% up, depending on how it ends today. So it is better, but it certainly was not what we were expecting in the second half, but it isn't over yet. Typically, if you look historically, the Christmas Santa Claus rally takes place on Thursday. So we're seeing a little bit up today. We'll see with all the information and all the negativity out there, whether Santa's going to show up and we're going to have Santa Claus rally. It's very possible we could rally into the year end. And typically, if you look back on all of these, and this is a very reliable indicator, we may start to see this market move Thursday upward. Maybe it's already starting today, but we're in unusual times. We could miss Santa this time. So we'll find that out.
If Santa doesn't show up, my kids are going to be very disappointed. Just saying, Tom.
I think
Hey, as Tom gets started here, just a reminder too, if you have any questions while Tom is presenting his message here today, feel free to shoot me an email. I have my email open here. I'll be watching that if you have any questions. You're also welcome to comment if you're watching on LinkedIn or on Facebook. If you comment below, I will see those and I can bring those questions to Tom. So please don't hesitate. If you have any questions, post those down below and we would love to address them for you. All right, there you go, Tom.
Okay, so let's look at the bad news. Let's look at the wall of worry. We put that up almost every month. You know, what strategists are saying, why this market should go down or not go up. So we'll start with the first one. 2 months of CPI dropping did not even convince the Fed. And you remember the last speech the Fed Chair Powell gave, I think he got out of bed on the wrong side. His tone, everything was sort of Jackson Hole-ish, if you remember back when he turned everything upside down at Jackson Hole, and he was very hawkish. He seemed very hawkish this time, but if you read between the lines, I don't think he said anything that probably was not that we weren't expecting. But what we did see, he just had this tone about him, and so the markets, did a reverse. If he would have had a little glimmer, a little hope, this whole thing would be different, but he didn't. So we're dealing with that right now, and that's why the markets are down since he spoke. So what happened? The Fed, he indicated that there's a ways to go, increasing the odds of a deeper recession. In other words, they're going to continue their hawkish rate hiking. It's probably going to be much lower. They only did 0.5 point this last time. We don't know what they're going to do going forward. But he did say, hey, we got more to go. So that the market took that extremely negative, rather than maybe an olive branch, which he did not show any olive branches. So his mood again was not very strict. He wasn't very joyful in that speech. So what are they looking for? The Fed's looking not necessarily the day-to-day financial changes or the CPI. Of course, they're looking at that, but they're looking for a weak labor market, and they think that's an ingredient that must happen before they'll start to turn in a different direction. Another point that we're seeing by strategists is that they think earnings are going to come down big time, and we're going to enter an earnings recession in 23. Now, you got to remember that most of these same people said we were going to be in an earnings recession this year, 2022. It did not happen. In fact, the earnings came in much better than most people thought. We were on the side that it was not going to happen. So we did get that one right. But now they're pushing it over into 23, and they think it's going to be a bad earnings period coming forward. Another thing we all agree on is that layoffs are increasing fast. So, but this is maybe good news because it has to do with the labor market. So, and remember, good news in the economy is bad news for stocks when the Fed's raising rates. Now, if it goes the other way, it's inverse of that. So we're going to have to see what happens with the layoffs and the coming jobs numbers and see how fast this thing is coming down. We'll talk more about that. Now, many strategists believe the PE ratio is going to contract with all that's going on, rising rates, falling earnings, and may go to 15 or 16, which makes the S&P go lower than where we are now. We disagree, and we'll be sharing that later in the presentation, but this is a possibility, and this is what strategists are looking at right now. Also, we just said this, good economic news is still bad news. So if we get any good numbers, which we have been, the economy has been surprising to the upside, which then they say, well, the Fed's got to do more work. And that's causing stocks to go down. So overall, as I talk to investment strategists and read lots of research, there's a lot of deep skepticism. Many strategists still believe we haven't seen the bottom yet. And we'll talk more about that they're still coming. The bottom in 22 is going to be lower in 23. And we'll talk more about that. We're not in that camp, and we'll be telling you why. So are there any positives out there? Should you be buying stocks? And we've got a number of reasons here. And we have some graphs that back some of this up and we'll go to. But number one, inflation is rolling over hard. I don't think anybody disagrees. We've seen the peak in inflation and it's starting to roll over. Not just roll over easy, it's rolling over hard in many areas. Two, in our view, the lower CPI numbers, we think that's a game changer. Obviously, the Fed didn't kind of blink, but we think there's more of those to come because what happened in the last two CPI numbers, we believe there's repeatable numbers coming, that it just doesn't end, but it will continue in a trend downward. And this will be very good for reducing the inflation rate. And here's the other thing, US economy has been remarkably resilient. We've been in that camp. We got that one right. So many people thought we were already in a recession. We're going to be in a recession in 22. It just didn't happen. So falling inflation revives that we're seeing, we believe, revives the possibility of a soft landing. Many people have abandoned the soft landing, but there are some big firms, well-known firms, that still think a soft landing is possible. And we're one of those that kind of give it a 50-50. You'll see our outlook for a soft landing or soft recession. We could go either way. Either way, it's going to be, we call it soft and soft. I think I came up with that phrase a few months ago, soft or soft. So that's what we think is going to happen. So, and the other thing is employment's still strong, surprisingly, although layoffs are increasing, and we'll talk more about that. And here's another one. We just had a big down year this year. Historically, you can go all the way back. We'll see a chart on this. When you have a down year in the S&P 500, 18 out of 21 times stocks go higher the next year. So we're going to see that there's a higher probability because of where we are this year that we'll have a positive return next year. I know, I think Luthold, who's a Minneapolis firm, they're very bullish on the market in 23. There's others too. So we're not alone here. But we think there's a high probability of a good return, not initially in 23, but we'll talk more about that. So here's another one, high yields, which is a credit indicator. This is the kind of fixed income that has the highest risk in terms of credit. And it had a bad year this year. Historically, when you have a bad year in high yields, in the high yield market, it's followed by a big credit and stock rebound the next year. There's a high probability for that. So we have a number of things that have happened negatively this year that could set up something for next year. And we're going to look more at that. Here's the other one, PE, the price earnings ratio, which is a valuation measure, likely to expand at a 10-year between 3.5 and 4.5. And we're around 3.6 right now. It's been bouncing around 3.5, 3.65. So we're on the lower end. And if you look since 1930, PEs don't contract, price to earnings ratios. They actually expand when you're in that range. And that's the anticipation of where the 10-year yield will be. Many were thinking 15 to 16. That just doesn't jive with history. And we'll look at a chart on that. So here's another one. And we all know this, the stock market's already beaten up. How much of the bad news is already built into the pricing? We think the downside is more limited. And we personally believe we've already seen the bottom in the stock market earlier this year. Now, earlier this year, the bond market tends to be an incredible forecast of what's going to happen in the stock market, what's going to happen, because it's a very sensitive to all the information going on. And earlier this year, the bond market and the yields in the bond market were indicating that the Fed was behind the curve on fighting inflation. That has now shifted, where the bond market today is indicating the Fed has maybe gone far enough because the 2-year is below the Fed funds rate. So what we believe is happening, the bond market's been very accurate on what's to come. It is telling us that maybe the Fed should be slowing down or even stopping. So we're going to look at some charts. Our stocks setting up for a big 2023. And this chart is showing the bottom historically of the stock market. We have 16 occurrences. So this is a lot of occurrences. And what it shows, because many people are talking about earnings, they're worried about earnings. They think that's going to cause the stock market to go down further or deliver even a greater bottom than we've seen already. But that history shows that the stock market bottoms on average 11 to 12 months before the earnings bottom. So because the stock market is always looking out forward, a 12-month, 2-year period, it's looking into the future. It's a discounting mechanism that stocks tend to bottom way before the earnings hit bottom. And you get a big rally right when you're bottoming out in your earnings. So we're not worried about the earnings because we think this pretty accurate indicator is saying that, hey, the stocks will be on the run way before the earnings bottom, when they do bottom. Now, this is a lot of data. Eric really liked the chart, but he had to wade through all these numbers, and I'm going to try to just sum it up. So this is that 18 out of 21 positive, but really what it shows is that when you have a bad year in the stock market, an annual decline, again, 18 out of 21 had a strong next year. And in fact, the average is over 13%, and the median's even higher. So what this tells us, that this kind of, and based on history, we may have a big rally coming next year. And there are a few big firms that agree with us, and we think that's going to happen. And at the end of this presentation, I'm going to tell you exactly when it's going to happen. All right, so here's another one we talked about in our positives, or why you should be buying stocks. Here's the high yield down year, typically followed by big rally in stocks and credit. And we do believe next year bonds are going to rally and stocks are going to rally. And if you look at the top chart where it says spreads rally, the higher that number you can see is that what the market is saying, there's a lot of risk out there in the economy. What's interesting with all the bad news and all the negativity, the spreads for high yield are dropping. And if you can look at the bottom chart, which is the high yield on HYG, which is a ETF of high yield stocks, it's starting to break out. You don't see rallies in high yield if the bottom's going to fall out of the economy. So this is saying, at least the bond market, which is very good and accurate for what's going to come, it is saying that it's not that bad out there, and we could get a rally in stocks next year and in bonds. And that's what we're expecting. We'll talk more about that. If you look at the little box on the right, the S&P 500 year after an H high yield negative return, because remember, high yield got, was like everything else in the fixed income, got hurt this year. But look at what happens typically the next year when you get a negative high yield return. The average return is 22%. So all these cumulatively put together are saying there's a lot of things happening in the historically that may point to a good market next year. Now, this is the price to earning ratio. This is very difficult to see, but you can see the upper line average, and it shows a 10-year is higher and where the PE on average is. And you can see when it's a higher PE ratio, a higher yield, if it's not over 5.5%, because if it gets to 6%, then it shifts. But as long as we're in this 3.5 to 4.5 range, it's normally, historically, we've had pretty good PE ratios up in the 18, 19, which means there's upside in the S&P 500. Now, because many people are thinking 15, 16, because the earnings are going to come down, many other reasons for that. We don't see it since 1930. This has been the case. So, 1990 here, you can see that. So what it tells us is we're not worried about a contraction in the PE at this point. Now, this is a little more, I think our circles and lines got a little off here, but this is the stock market, what happened in 1982. And if you remember, Paul Volcker, the Fed chairman, to fight inflation, raised rates significantly, caused a 27% drop, in that time period. You can see the minus 27 from the top to the bottom. But if you look at the blue at the top, it says Volcker suggests Fed may shift. You can see that most of the losses were already recovered before the Fed chairman mentioned when he would stop raising rates. And then it was shortly after that, just in 4 months, it rallied so fast that all the losses were recovered in very short order. Now, this has happened. This was similar to what we're dealing with today, super high inflation. But what it means is the stock market can move in advance of a Fed pivot. And we believe we're going to wag the dog. We'll talk more about that.
Yeah, sorry, I must have moved those circles there a little bit. Just trying to get a different one. Well, anyway, you explained it well, so thank you.
Okay. So here's another one that's making the case for a Fed shift this year. Now, remember, in his speech, Paul didn't make any indication, but he did say we will be data driven. He talked about they're going to look at the data. Well, let's look at the data. Here's the core CPI and PPI. Now, we're not looking at a trailing 12. We're looking at a 3-month change because it takes a long time for a 12-month to get into the numbers. But you can see both the PPI and the CPI were two measures. PPI is what what companies are paying for goods, the CPI is what we're paying for goods, they're all dropping like a rock. And again, we think it's repeatable. We're going to have an inflation number this Friday. It's PC. It's one of the Fed's favorite ones, and we'll see if it comes down similar to the CPI and PPI. But the evidence, and that you'll see, I've saw an article. Maybe you have. Wall Street's wondering what data the Fed's looking at, because everybody sees everything coming down in a direction that the Fed wants. So why aren't they looking at the same data? And that's a good question. Again, they're looking at labor. They're looking at jobs. They want more unemployment, more wage reduction. So we'll see. But everything here, and we think it's repeatable, we'll see it in January, is coming down. Here's an interesting chart. We've been talking about oil and wheat, and most people don't know this, but wheat and oil are now below the Ukraine-Russia war start. In other words, they have dropped below the beginning of the war when all wheat and oil shot up. Now they're even lower. This is really good for lowering inflation going forward, because wheat and oil are used in about everything. So we really need to look at these and say, hey, things are coming down in inflation. They're directionally going the right way. Now, a lot of talk over the last several years about supply chain. Here's supply chain costs by sea or airborne are tanking. Look at, they're all the way back from the beginning to where it was. We had a starting point almost, but you can see they're falling like a rock. 83% on sea and freight. Look at this, 33% drop in airborne. This is coming down hard. This all makes our goods and things that we buy less expensive, because this is the supply chain was the big reason that inflation shot up. Number one was the demand. Number two was the cost of getting it here. And so that's all coming down. So everything is directionally going in the right way with inflation. Here's services. CPI X shelter, taking out this shelter, it was negative the last 2 months. This is dropping because we were talking about goods. Now even services is starting to show some weakness in the pricing, and that's starting to come down. All right, the Fed's aggressive rate hikes are already working. And there's been a lot of talk among Wall Street analysts about there's a lag effect when the Fed raises rates, that the impact starts happening, but there's a lag effect. And once it starts happening, it just continues in the same direction. And that's why the Federal Reserve could go too far, because they don't see the actual numbers until months later. And by then, they've gone overboard. And so there's a lot of talk about that. But we are already seeing this aggressive rate hike that the Fed's what they're trying to do is working. Now here's a very difficult chart to see. The far left one, you'll see a yellow on the far left chart. That's Volcker. That's how fast he raised rates. Now you can see that most of the rate hikes historically have been kind of flatter. You can see all the gray ones historically. And then you can see 2022 in the orange. And so the projection is right a little higher. That's where we're expecting to go, somewhere around 4 to 5% in that realm. But you can see how fast the Fed has raised rates. Now it's having an impact on home sales and prices. Now, one of the big CPI numbers is the cost of living in a house or rental. We're seeing, if you can look there, you can see similar to the 1980, you can see how 22 it's coming down. So this is all good news, because that's kind of a stickier inflation number, but we're starting to see it roll over. And just as just another view, we can see rent indices showing signs of rolling over hard. apartmentless, Zillow. So this is all good news for the inflation rate, and it should be incorporated by the Fed as they are data driven going down into the future. Retail sales, they came in much weaker than expected. That's another good, like bad economic data is good for the stock market or good for the Fed's decision about lowering or raising or keeping the rates the same. So we're starting to see retail sales come down. Not terribly, but it is heading directionally. So the whole point is we think the Fed's super fast high rate hikes are working, and we're going to see those in the upcoming numbers. All right, so here it is. Looking at all this, wag the dog. We think that the data-driven Fed will eventually are going to see such evidence that the inflation rate's coming down, even wages are going to slow. So all of this is going to happen in 23. And it's going to end up wagging the inflation adjusting downward is going to wag the dog, the Fed, which will compel them to make a decision that would be positive for the stock market before many anticipate. Falling inflation, labor weakness shifts Fed to pivot earlier than expected. All right, so what do we, with that in our scenario, what are we looking at next year? We're looking either a soft landing or soft recession. We don't know. Maybe it's 50-50. We do not see a deep recession. And it really doesn't matter if it's a soft or soft, because that's not going to have a huge impact on the direction of the stock market. Now, if we went into a deep recession, if things came together and created a deep recession, that would bring the stock market down lower. But we think there's a 50-50 chance here of a soft or soft. We see corporate earnings coming down. They will, but it's no crisis. We think it's going to be sector by sector. Some sectors are going to be doing much better than others. Some are going to be doing worse than others. But overall, in aggregate, like energy is going to be most likely do very well, is one example. So we think there's no crisis in corporate earnings. And again, we looked at the chart. Even when corporate earnings bottom, the stock market's already moved and has already started to work its way back up. So it's going to be a very bumpy ride in the first half. We're expecting high volatility as all this information gets disseminated into the Fed's decision making and others' decision making. So it's going to be a bumpy ride, but we do believe there's increasing high probability of a double-digit return in 23. And it's going to happen at the first sign of a pivot. Now, it doesn't matter which pivot. We think it's any of these three. Maybe we'll get one or two of these. There's three types of pivots. Now, it used to be only one pivot, but now they got three different definitions. So one is where the rates hikes, instead of doing 0.5%, they do a quarter. Instead of doing a quarter, they do something less. So that's a lower rate hike. That is a pivot. Stop raising rates. They say, hey, we're going to hold. We're going to see how it all shakes out in the economy. We're starting to see signs that our efforts are working. We're going to kind of just sit back and see what kind of reduction in inflation and everything else is coming. And the third one, which may or may not happen next year, could happen at the end of next year. And that would be where the Fed says, we've gone too far, we're going to lower rates. Now, we don't expect that, but we do expect one of the two first pivots. And we think that will be a catalyst, a big catalyst for a big rally sometime in 23. So our forecast is probably in the higher end. There's a few of us out there. I'm on the probably towards the top of a 4,600 by the year end, but it starts after the first pivot. Now, we saw with Volcker, before he pivoted, the markets already started moving, so it could move in advance. So we're looking at explosive upside in stocks and bonds, both of them, somewhere around mid-year. I'm not going to put a date on that, but because I don't know when it's going to happen, but we're pretty confident that the inflation's going to wag the dog in the Fed. So we don't know. It could be a rough first quarter, it could be a rough first half. But whenever that market smells a shift and they start saying, hey, we're seeing enough data here, we're going to be wagged by the tail. So we'll see what happens. And that's our outlook for 23.
Awesome. Thank you very much, Tom, for that. Just a reminder, if you have any questions, we'd love to field any questions for you. I've been watching my email here. I've not seen anything come in. We do have a number of you out there, so thank you again for joining us here today. Um, let's see. Let me check a couple of other spots here. All right. I don't see any questions. I have a question that this has come up before, and maybe we can talk about for a minute here and see if any other questions come in. So a lot of the data, of course, is showing that inflation is coming down. You know, you've pointed to a lot of different things and rolling over hard. Um, and the question is revolves around the Fed going too far, and how do you monitor that? How do you, what are you looking for signs that maybe the Fed is waiting too long or going too far?
Well, that's a real good question. And it's difficult to determine that because it's a lagging what they do with interest rates, what they do with putting the hawkish view on, there's that lag effect. And so it's very difficult to say, is it going to be 3 months, 6 months, 9 months lag? And by the time it gets here, it's too late. So I think hopefully we're going to that the information on the economy and inflation and the labor market is significant enough to stop them or maybe pause or just do a little rate hike. We think that that's a possibility. Now, if they stay with the tone that Powell had at the last meeting and Jackson Hole and several meetings, then they could overshoot it. Now they're kind of tight on this 2% inflation. I don't think they're going to hold to that. I think if we get closer to 3.5, that they'll probably take their foot off the brake. But Eric, it's a good question because of all the lagging that's going to be there because of what they've done already. But they do have the ability to do the third pivot at some point if they do that. For example, if they overshoot it, they could lower rates. That's the third kind of pivot. If that happens, boom, stock market's up. But it is a possibility. And what could happen if they crush the economy, which a lot of strategists are worried about? Well, then we'll go into a deep recession and we will see lower lows. We just don't think it's going to happen.
We did have another question come in here. Rob, you're out there. Thanks so much for joining us. You, I can say, are very lucky that you're not here in Minnesota with us right now. I don't believe you are. I think you're down in Texas right now. But it is a balmy 5 below here right now. So it was a little tough getting going here this morning. But you had a question come in. Thanks so much for asking this question. So Tom, Rob is wondering, does money supply changes factor into the inflation rate?
It does, but it's not a primary factor, but it does have some input. It's not primary.
What is primary?
Primary is the CPI, the actual prices being paid is the primary, wholesale, retail, and so on. That's sort of an indirect impact, and it doesn't have like direct impact on inflation, but it will kind of tilt it one way or the other. It's not something we worry about, the money supply. But it has some minor impact, but it's not the major.
Great. Thank you. All right. We'll give it here a second. If anyone else has any questions, we'd love to field them for you. As always, a reminder, if you are watching in the recording, which I think we have more people watching the recording than are able to join live. If you are watching in the recording, please don't hesitate to either comment wherever you're watching, I do look at those, or maybe even better if you have a minute to shoot me an email, and we would love to circle back with you with any questions that you have. So again, Rob, thanks so much for asking your question. We certainly do appreciate that and value the opportunity to answer those questions. But with that, I think I will close us up here. Tom, do you have any closing remarks you'd like to add?
No, if you're still in Minnesota, stay warm.
Yeah,
Get your snowblower ready because I hear we're having a big, huge storm coming our way. So maybe go to the
yeah,
grocery store early and be preemptive.
yeah. Cannot agree more. We've got a big storm coming here. Rob says it's going to freeze here in Texas. Yeah, it's. I think the storm that's coming is across the whole country. So everybody, as Christmas approaches here, the holidays approach, stay safe, stay warm. From all of us, we wish you a very Merry Christmas, a very Happy New Year. We will have an updated calendar of events on the website soon. Of course, we do this call every month, and we look forward to seeing you all next year in January for our monthly capital markets update and outlook call for January 2023. With that, I will go ahead and close this out. So again, thank you all for joining us here today, and have a wonderful rest of your year. Thanks, Tom.
Thank you.